How to become a rich pensioner. This is a war for your financial well-being. Listen carefully. This is not a lecture. This is a battle plan. This is a strategic briefing about your future, your independence, and your survival in a system that rewards discipline and punishes hesitation. You can spend your entire life waiting, for someday, and later, for the right economy, the right job, the right connection, the right moment when everything feels safe. Or you can act right now, with clarity and intention, understanding that imperfect action today is more powerful than perfect plans tomorrow. Every year you postpone is a year compounding works against you instead of for you. Time is either your ally or your executioner. There is no neutral position. If you are not building assets, you are funding someone else's. If you are not designing your future, you are drifting into someone else's design. I speak harshly because soft words do not change destinies. Comfort does not create strength. Gentle encouragement rarely breaks destructive habits. Motivating yourself in the morning with maybe is a luxury of the poor, because maybe keeps you average, and average keeps you dependent. The rich do not wait for permission. They do not wait for applause. They do not wait for guarantees. They take action before they feel ready. They systematize their behavior so discipline replaces emotion. They take calculated risks instead of emotional gambles, and they manage money as a tool of power, a lever that multiplies effort, expands options, and buys freedom. They understand that income from labor has limits, but income from assets scales. They know that salaries can be reduced, jobs can disappear, and markets can fluctuate, but ownership, equity, and productive capital create resilience. They track numbers. They measure performance. They adjust strategies. They build systems that work even when they sleep. If you want to be among those who live off interest rather than a salary, listen and act. Study the mechanics of wealth. Master saving, investing, risk management, and delayed gratification. Accept short-term discomfort for long-term autonomy. Not one step back. No excuses. No blaming your circumstances, your education, your upbringing, or the economy. Responsibility is heavy, but it is also empowering. This is not about greed. It is about control. It is about ensuring that your future self is protected, respected, and free. The world does not reward intentions. It rewards execution. Decide who you will become. Build the habit of decisive action. Replace hesitation with preparation. Replace fear with education. Replace excuses with execution. The battle is internal before it is financial. Win that, and the rest becomes strategy. The wealth paradigm, what it means to be rich in retirement. Being rich in retirement means having a pool of assets that covers all your living expenses without the need to work. This is not luxury, it is mathematical freedom and psychological peace. 3 key pillars. 1. Income-producing assets, investments, businesses, real estate with positive cash flow. 2. Expense management, discipline that multiplies the effect of income. 3. Time and growth rate, the earlier you start, the fewer sacrifices you need and the greater the compound growth effect. Remember one idea and strike it again and again: money does not come to those who merely wish for it. It comes to those who systematically attract it, preserve it, and make it work. Rules of the battle, 12 tough principles that will take you to retirement with capital. Short. Each is a command for immediate action. 1. 100% responsibility for your finances, no one is coming to solve it for you. 2. First, an emergency fund covering 3 to 6 months of expenses. Without it, you are vulnerable. 3. Live below your means, save at least 20 to 40% of income growth. 4. Invest systematically, dollar cost averaging, regular contributions. 5. Diversification, stocks, bonds, real estate, business, protected assets. 6. Glide path, reduce portfolio aggressiveness with age. 7. Tax efficiency, use retirement accounts, deductions, and tax advantages. 8. Financial literacy, read, learn, apply. 9. Capital protection, insurance, legal safeguards, currency diversification. 10. Reinvest income, do not consume dividends unnecessarily. 11. Continuous optimization, review your portfolio at least once a year. 12. Mentorship and environment, choose people who lift you up, not drag you down. These rules are not up for debate. They are executed. The choice is yours. Assets and historical benchmarks, concise and practical. For the plan to work, you must understand asset behavior. Below are real historical benchmarks, approximate, based on long-term data. Stocks, S&P 500. The long-term nominal return of the U.S. stock market, S&P 500, including reinvested dividends, has been around 10 to 11% annually over very long horizons. That means capital historically doubled approximately every 7 to 8 years under average conditions. Bonds. Government bond yields are more stable but generally lower than stocks. Over recent decades, yields ranged from high levels in the 1980s to extremely low levels in the 2010s. Bonds protect capital and reduce portfolio volatility. Data sources include U.S. Treasury statistics and Fed. Real estate. According to the Case-Shiller Home Price Index, average annual growth rates vary by U.S. region, but over the long-term nominal returns have been several percent annually plus rental income. Real estate offers inflation protection and tangible value. Cryptocurrencies, Bitcoin. Extreme volatility. Bitcoin has had years of returns in the thousands of percent and years of deep drawdowns, minus 70% or more. It is a tool for speculation and high returns, but with maximum risk. History shows both enormous gains and severe losses. Business. Small businesses can generate returns unavailable in public markets, but risk is high. Statistics show many startups close within the first 3 to 5 years. Success depends on margins, cash flow management, and scalability. Age-based strategies, concrete plans, 25/35-45 years old. Below are clear instructions for 3 age profiles. These are scenarios, take them and implement immediately. Age 25, young and aggressive. Goal, maximize capital growth using time advantage and high risk tolerance. Starting point, little or no capital, moderate income but strong potential to increase it. Step-by-step plan. 1. Psychology, become a hunter. Do not let fear block action. 2. Emergency fund covering 3 months of expenses. 3. Saving system, invest 20 to 40% of income monthly, 50% if possible. 4. Portfolio allocation, aggressive example. 80 to 90% stocks, S&P 500 index funds plus international equities. 5 to 10% bonds/protected assets. 5 to 10% alternatives, crowd investing, crypto, venture bets. 5. Start a parallel project, freelance, online business, product, create a second income stream. 6. Education, study finance, taxes, accounting, marketing. Every hour invested is capital. 7. Reinvest all returns, avoid unnecessary consumption. 8. Weekly action, 1 concrete step to increase income. Example, investing $200 per month in an index fund at 10% annual growth for 20 years can generate significant capital. It is not magic, it is time. Age 35, the accelerator. Goal, scale assets and shorten the path to financial independence. Plan. 1. Cut unnecessary expenses. Every raise goes toward investments. 2. Balanced portfolio. 60 to 75% stocks. 15 to 25% bonds. 10 to 15% real estate/business. 3. Maximize tax advantages. 4. Scale business if you have one. 5. Invest in income-producing real estate if possible. 6. Use leverage wisely, for assets, not consumption. 7. Protect family with insurance. Age 45, finish line reinforcement. Goal: preserve capital while maintaining growth. Plan. 1. Adjust risk, 50 to 60% stocks, 30 to 40% bonds, 10% alternatives. 2. Calculate retirement needs realistically. 3. Focus on dividend stocks, quality rental property, medium-term bonds. 4. Scale or monetize business. 5. Gradually lock in gains to reduce risk. 6. Create a family wealth system. Practical tools: no fluff, only numbers and action. Stocks, growth engine. Use S&P 500 ETFs as a core. Historically 10-11% long-term average. Diversify. Rebalance annually. Bonds, stabilizer. Use quality government/corporate bonds. Increase allocation with age. Real estate, income plus appreciation. Buy for positive cash flow. Calculate after taxes and expenses. Crypto, high risk. Limit to 1 to 5% of portfolio. Expect 50 to 80% drawdowns. Business, strongest leverage. Focus on margins and scalability. Measure everything. Historical lessons, successes and mistakes. Success, discipline. Warren Buffett demonstrates long-term discipline and value investing. Mistake, emotional trading. Trying to time the market destroys wealth. Long-term systematic investing historically outperforms emotional reactions. Mistake, consumption without planning. Income does not equal wealth. Wealth is accumulated working assets. Income scenarios, in words. Minimal start, $100 per month for 30 years can grow into meaningful capital. Medium, $500 per month plus side business can cover family expenses in 20 years. Aggressive, saving 40 to 50% and investing in business plus real estate may lead to independence in 15 to 20 years. Wealth psychology. Track monthly progress. Pay yourself first. Learn from others' mistakes. Avoid showing wealth prematurely. Learn to say no. First 12 months action plan. Months 1 to 3, audit finances, automate investing, build emergency fund. Months 4 to 6, launch index investing, increase income, study. Months 7 to 9, explore real estate, optimize taxes. Months 10 to 12, review and adjust. Common objections. I don't have money. Start small. It's too risky. Not investing is also risky. I don't know how. Learn 30 minutes a day. Taxes and legal structure. Use retirement accounts, deductions, and tax planning. Consult professionals to protect capital. Final 9 steps. 1. Take responsibility. 2. Build emergency fund. 3. Automate savings. 4. Invest in index funds. 5. Build additional income. 6. Add real assets. 7. Limit high-risk speculation. 8. Protect capital. 9. Review annually. Conclusion: hard call to action. Stop planning and complaining. Stop analyzing your fears. Stop waiting for the perfect moment, because the perfect moment does not exist. It never has, and it never will. You have 2 choices: feed the markets, or make the markets feed you. Either you spend your life working for money, or you build assets that work for you. Either you stay a consumer of systems, or you become an owner within them. I gave you the map and the weapons, historical benchmarks, age-based strategies, first-year tactics, and concrete, practical steps. This is not theory. This is not motivation for entertainment. This is execution material. The difference between those who retire wealthy and those who struggle is not intelligence. It is not luck. It is disciplined action repeated for years. Pull yourself together. No one is coming to rescue your future. No government program will magically make you financially independent. No employer owes you a wealthy retirement. Your financial destiny is built by your daily financial behavior. Start today. Not next week. Not next month. Today. Make the first transfer to your investment account. Even if it is small. Especially if it is small. Because the size of the first transfer is irrelevant, the habit of transferring is everything. Action creates momentum. Momentum creates confidence. Confidence creates scale. Write down 3 actions you will complete in the next 24 hours. Be specific. Learn about investing is not specific. Open an investment account, set up automatic transfers, review monthly expenses and cut one unnecessary cost, those are actions. And begin with the most uncomfortable one. The one you've been postponing. The one that makes you hesitate. Growth lives on the other side of discomfort. Understand this clearly, wealth is not built in dramatic moments. It is built in quiet, disciplined decisions that no one applauds. It is built when you choose investing over impulse spending. It is built when you reinvest dividends instead of consuming them. It is built when you study financial statements while others scroll social media. Rich people act while others hesitate. They move while others debate. They execute while others doubt. They are not fearless, they simply refuse to let fear dictate their behavior. They understand that inaction is also a decision, and usually the most expensive one. Time will pass anyway. 10 years from now, you will be 10 years older, that is guaranteed. The only question is whether you will be 10 years wealthier. Every month you delay is compound growth lost forever. Every year you postpone is capital that will never have the chance to multiply. Do not underestimate the power of consistency. A modest investment made consistently over decades can outperform large, sporadic attempts driven by emotion. Financial independence is not a lottery event. It is a system. And systems reward discipline, not excitement. If you want to live on interest instead of salary, then start building interest-producing assets. If you want freedom, start purchasing it, one investment at a time. Freedom is not given. It is accumulated. You already have everything you need to begin: access to information, access to markets, and the ability to make decisions. What remains is commitment. Not excitement. Not temporary motivation. Commitment. Let this be the moment you stop being a spectator of other people's financial success. Let this be the moment you decide that retirement will not be a period of survival, but a period of power and peace. Let this be the year you move from intention to execution. Make the transfer. Set the system. Protect the capital. Grow the assets. Review annually. Accelerate when possible. Stay disciplined when it's hard. Rich people do not wait for certainty, they build probability in their favor through action. Let this be your year.